Hi guys, today Miss Yuwen and my fellow teammates Poishan, Julian and Takif are going to present to you the role of ratio decision.
Why is ratio important? The calculated result can determine how the business can move forward and can look for a strategic decision. Should a company buy another? Should invest in new equipment? Wherever to develop a new product line? And lastly, enough strategy to expand into other countries. Type of ratios. Liquidity ratios. It measures the company capability to pay its payable current liabilities. Second, leverage ratio. Measure how the company is financed from the creditor's resource. Third, activity ratios, which measure how efficiently company use its own resource. Fourth is the economy ratios, which measure the relation between revenues and expense. That is, they show how much revenue is achieved per unit of expense. The fifth is the probability ratios, which measure the returns of the invest capital and show the highest managerial fictions. Finally, the investability ratios, which measure the efficiency of investment in ordinary shares. Way to compare ratios. The first thing to do is plan ratio for analyzed period. The second thing to do is the ratio value change through specific period in the same company. Third, ratio value in the similar company that belongs to the same group. And lastly, the average ratio value of other companies that belongs to the same group.
There are three ratios, which include current ratio, liquid ratio, and receivable turnover and collected period. Analyzing liquidity. Liquid assets are those assets that can be converted into cash quickly. In quick ratio, we can subtract the inventories from total current asset since they are the least liquid asset. A financial analyst may examine the ratio of cash and equivalent to current liabilities. One of the most widely used financial ratios is the current ratio that is taken from the balance sheet. The current ratio measures the company's ability to pay current liabilities with current assets and how well it can manage the debt obligation. Obviously, if the company is unable to repay debt or make timely payment of interest, it will be forced into bankruptcy, and increasing current ratio from period to period indicates improvement in financial position. The following ratio shows that firms' reliance on external debt for financing. Any number above 100% shows that the company relies on external debt for financing some of its assets. If the number equals 100%, it means the assets are fully financial by the shareholder. The last ratio shows that the company also shows the reliance on external source for financing its assets. Analyzing sales and profitability. Profitability is a relative term. Profits will depend on the product life cycle, competitive conditions in the market, borrowing costs, or expense management. The set of ratios here includes some of the traditional earnings-based performance measures such as return on sales, return on assets, return on investment, and return on equity. The above formulation clearly shows that if management wish to improve their return on equity, they need to improve profitability, efficiency, use the assets, and optimize the use of debt in their capital structure. Sustainable growth rate shows how much the company will grow in the future if some of the key ratios remain the same as its previous years.
This ratio reflects how well the firm's assets are being managed. The inventory ratios show how fast the inventory is being produced and sold. Ratio 1 shows how quickly the inventory is being turned over to generate sales higher. Ratios 2 show how many days the inventory was held in the shelf. Ratio 3 shows how much sales the firm is generating for every currency unit of investment in assets. Ratio 4 and 5 show the firm efficiency in collecting from credit sales. Ratio 6 and 7 focus on efficiency in making payments. The use of multiple discriminant analysis helps to consolidate the effects of a set of ratios by looking at a number of separate clues. It would be more useful to combine the difference ratio into a single measure of the profitability of failure. So the slides shows one of the example, and the conclusion is C-score, which can be used to classify firms as score above 2.675 or ahead towards bankrupt, a score below 2.675. The lower the score, the greater the chance of bankruptcy.
Profit margin. Profit margin look at how much of the sales revenue is converted into profit. Gross profit margin equals to gross profit divided by turnover and times by 100. The higher the better. Allows the firm to assess the impact of its sales and how much it costs to generate those sales. A gross profit margin of 35% means that for every £1 of sales, the firm makes 35p in the gross profit. Debt collection period. This look at how long it takes for the business to get back its money owed. Debtors collection ratio equals to debtors times 365 and divided by turnover. The lower the figure, the better, as cash get more quickly. However, sometimes need to offer credit terms to customers, so this may increase it. Need to ensure keep track of any changes in credit term at this show impact this ratio. Trend analysis. Using the past history of a firm for comparison is called a trend analysis. By looking at the trend in a particular ratio, one sees whether that ratio is falling, rising, or remain relative constant. For this, a problem is detected or good management is observed. Stock turnover ratio. This ratio establishes the relationship between the cost of goods sold during a given period and the average stock holding during that period. It tells us as to how many times stock has turned over during the period. It indicates operational and marketing efficiency. It helps in evaluating inventory policy to avoid overstocking. Inventory turnover equals to cost of goods sold divided by average stock. Cost of goods sold equals to sales minus gross profit over opening stock plus purchase minus closing stock. Average stocks equals to opening stock plus closing stock over 2.
So this is the real case from Tiffany & Co. company, and it shows their inventory turnover.
This is the real case that includes the liquidity ratio and the current ratio, which include liability and assets in a problem. This is the solution, which include current solution equals to current asset divided by current liabilities, in which it also equals to stock plus debtors plus bank plus prepaid expenses divided by creditors plus provision for taxation. The second solution will be liquid ratio equals to liquid assets or quick assets over current liabilities, which include debtors plus cash at bank over creditors plus provision for taxation. In conclusion, we can assume that a company is not running well based on the current ratio and the liquidity ratio.
Thank you for your time.